Greetings, esteemed viewers. I am Trang, and welcome to our in-depth analysis of the escalating global market turmoil. Today, we delve into the deepening anxieties surrounding a potential global recession, fueled by the ongoing trade disputes initiated by the United States. Investors are exhibiting heightened nervousness, triggering a widespread sell-off of riskier assets across international markets. The tremors are palpable across Asia, with Japan's Nikkei 225 index currently registering a significant decline of 6.3%. The broader Topix index in Japan has also suffered a substantial 7% loss. While these figures represent a partial recovery from steeper intraday drops, the overall sentiment remains decidedly bearish. In South Korea, the Kospi index is down by 4.5%, reflecting similar investor apprehension. Australia's S&P/ASX 200 index experienced an immediate 6% plunge upon market opening. Though it has since pared back some losses to a 4% decline, the index has officially entered correction territory, having fallen 11% from its February peak. This signifies a marked shift in investor confidence and market stability. The Chinese stock market is also experiencing a sharp downturn. The Shanghai Composite Index is currently down 5.5%, extending losses from earlier trading. Hong Kong's Hang Seng Index has been particularly hard hit, plummeting nearly 9%. These declines underscore the significant impact of trade tensions on major Asian economies. In Taiwan, authorities were compelled to activate circuit breakers in the stock market earlier today. This drastic measure was taken after shares of key technology giants TSMC and Foxconn both tumbled nearly 10%. Taiwan, a critical trade partner of the United States, faces substantial retaliatory tariffs at a rate of 32%. This underscores the direct and immediate impact of trade policies on specific economies. TSMC, the world's largest contract chip manufacturer and a primary supplier to major U.S. hardware companies, is at the heart of this trade friction. Just last month, the U.S. President and TSMC's Chief Executive Officer, referred to in reports as Mr. C.C.C. Wei, jointly announced a massive $100 billion investment by the chipmaker to construct 5 new factories in the United States over the coming years. This move, while presented as a win for domestic manufacturing, occurs amidst escalating trade tensions. Adding to the complexity, approximately 90% of Apple's iPhones are assembled in China by Foxconn. According to estimates from research firm Evercore ISI last month, China is currently facing retaliatory tariffs of 34%, pushing the total additional tariffs imposed since the current U.S. administration took office to a staggering 54%. This highlights the intricate web of global supply chains and the vulnerability of major corporations to trade policy shifts. Futures markets for U.S. equities are also signaling further declines. Dow Jones Industrial Average futures are currently down 1.200 points, or 3.3%. S&P 500 and NASDAQ 100 futures are down 3.8% and 4.8%, respectively. These figures foreshadow a potentially turbulent trading day in U.S. markets. European stock market futures are mirroring the global downturn. Euro Stoxx 50 futures are down 3%. FTSE futures in the UK are down 2.7%, and DAX futures in Germany are currently down 3.5%. This synchronized decline across major global markets reinforces the systemic nature of the current economic anxieties. Interestingly, the U.S. president, referred to in reports as Mr. Donald Trump, stated on April 6th that he is not concerned about the stock market downturn. He likened the market correction to medicine, stating, "I don't want anything to go down, but sometimes you have to use medicine to cure the disease." This perspective appears to downplay the severity of market reactions. The U.S. president's sentiment aligns with statements made on April 6th by the U.S. Secretary of Commerce, referred to in reports as Mr. Howard Lutnick, who indicated that the administration intends to proceed with tariffs against major trading partners, even amidst the global market sell-off. Furthermore, the U.S. Secretary of the Treasury, referred to in reports as Mr. Scott Bessent, revealed that over 50 economies have expressed interest in initiating trade negotiations since the announcement of retaliatory tariffs. This suggests a continued commitment to the current trade policy direction, despite market volatility. Earlier, on April 5th, a spokesperson for the Chinese Ministry of Foreign Affairs, referred to in reports as Mr. Guo Jiakun, posted on social media that the market has spoken regarding the U.S. import tariffs. Mr. Guo's post included an image depicting the sharp decline in U.S. stock markets, implying a direct causal link between trade policies and market performance. U.S. stocks experienced a significant sell-off last week following China's announcement of retaliatory import tariffs. Canada had also previously taken similar retaliatory measures. Last week also marked a historic moment, as the Dow Jones Industrial Average recorded 2 consecutive sessions of declines exceeding 1,500 points for the first time. The S&P 500 lost 5.9%, its worst performance since March 2020. The Nasdaq Composite, heavily weighted with technology stocks, fell by 5.8%. These figures highlight the magnitude and breadth of the recent market downturn. In the currency markets, investors are flocking to safe haven assets such as the Japanese yen and the Swiss franc. The Swiss franc has risen over 0.6% to 0.85 Swiss francs per US dollar. Last week, the franc appreciated by 2.3% against the US dollar, indicating a strong preference for safe currencies. Concurrently, the US dollar has weakened by 0.45% against the yen. Currently, 1 US dollar is exchanging for 146.2 yen. Earlier on April 7th, the dollar briefly depreciated by over 1% against the Japanese currency, demonstrating the yen's strength as a safe haven asset. Global gold prices have exhibited significant volatility at the start of trading on April 7th. Initially, gold prices briefly fell to $2.09 per ounce, breaching the $3,000 mark for the first time since mid-March. However, the market swiftly reversed course, and gold prices are currently trading at $3.04 per ounce. This price fluctuation reflects investor uncertainty and shifting market dynamics. Last week, the gold market experienced several consecutive days of sharp declines, driven by investor profit-taking after prices reached a peak of $3.169 per ounce on April 2nd. Following the U.S. announcement of retaliatory tariffs against all trading partners. Another contributing factor is margin calls, as losses in other asset classes like equities have forced investors to liquidate gold holdings to meet margin requirements. This morning's market movements align with predictions from Kitco News last week. Experts anticipate continued downward pressure on gold prices in the short term, citing the aforementioned profit-taking and margin call pressures. However, the medium-term bullish trend for gold remains intact, underpinned by unresolved global uncertainties. This suggests that while short-term volatility is expected, gold's safe haven appeal will likely persist in the longer run. It is important to note that the Vietnamese stock market and domestic gold markets are closed today for the commemoration of the nation's ancestors. Therefore, we will not see immediate reactions in these markets until they reopen. Crude oil prices are also caught in the global downward trend. Brent crude is currently down 2.8% to $63.7 per barrel. U.S. West Texas. Intermediate WTI crude is down by a similar percentage, trading at $60.2 per barrel. Investors are concerned that the escalating U.S.-China trade tensions could trigger a recession, leading to reduced global oil demand. China is currently the world's leading consumer of crude oil, making it a critical factor in global oil market dynamics. This concludes our initial analysis of the developing global market situation. We will continue to monitor these events closely and provide further updates as they unfold. This has been Trang, bringing you the latest market insights. Stay tuned for further analysis and developments. Thank you for joining us. This is a synthesized analysis compiled using large-scale language data, providing rapid and up-to-the-minute insights to offer you a comprehensive perspective.